We're value investors at Pzena Investment Management. And so when we hear someone say that something's uninvestable, we get excited. I mean, to us, uninvestable means it's the thing that you probably want to take a really close look at. It may be uninvestable, but when we've looked historically at countries in emerging markets that underperform in a major way over the trailing 12 months, they tend to outperform in a very major way over the subsequent 12. Now, China has been underperforming for a number of years now. And when we look at the underperformance of emerging market equities over the last few years, it's really the story of the underperformance of China. In our view, there have been a lot of babies thrown out with the bathwater. I mean, if we had had this conversation 3 years ago, we were massively underweight China. And now we have, over 30% of our portfolio in Chinese and Hong Kong equities.
So, I mean, BABA is one of your top 3 conviction calls, I know, in the EM universe. I mean, when you take a look at the metrics, basically anybody with a screen can see that it's trading at 10x, right? But you're buying BABA. Jack Ma has come out of the woodwork, and he's buying BABA too, and in bulk. What's the thinking behind that? I mean, it's at 10x. I mean, what's going to scale it up?
Yeah, well, look, we're in good company if Jack Ma's buying as well, but we have been buying for some time. Granted, we were early because the stock, has been continuing to underperform over the last few years. But when you take a look at the valuation today, it's extremely compelling, right? This is a company where the market cap's roughly $180 billion. And in that, you've got about $60 billion of cash, about $60 billion of investments. So that gets you to an operating enterprise value of around $60 billion. Last year, they generated $25 billion of free cash flow. So it's pretty hard to turn away from that, especially because this is the moment in the last few quarters where you're really starting to see the earnings bottom out and inflect. And despite the good news, the market is still just not acknowledging it. I mean, this is a company that has lost market share in e-commerce, admittedly, still 45% of the market. And we've seen in the last quarter the customer management revenue inflect and turn positive again, which is a very, very positive sign. Beyond that, you've now got 11% of revenue coming from overseas e-commerce. That's beginning to scale and become more profitable. They're the leader in cloud, 37% market share there, the clear leader. And that's also an area where they were losing money for a number of years, and that inflected in 2022. And so you're starting to see that positive profitability come through. But it's sitting in a bad neighborhood. No one will give them the benefit of the doubt because of the Chinese domicile.
Allison, let's talk about another, what's becoming a favorite EM market for a lot of folks, and that is India. And India's become sort of the anti-China, right? I know a lot of folks say that, look, it's expensive, and it is, right? There's always what's called a conglomerate premium attached to Indian equities, and that's been the case for decades now. For yourselves as value investors, that also it does make sense to you.
There's not much for us to buy in India. And it's not that we have anything against it. It's that we can't get ourselves to pay for high expectations. I mean, if you look at the performance of India versus China, for example, from the end of 2020, India's up relative to China about 100%, right? Meanwhile, in this period, China has had stronger GDP growth and earnings have grown. Now, the expectation, of course, is why the Indian stocks are so expensive. And we're believers in the Indian story as well. It's just we would rather invest in a place where the expectations are negative and the performance can be better than what's expected. I mean, when you look at the history of value investing, it's been a really great way to invest in emerging markets, despite the fact that people think that emerging markets are all about growth. Yes, people go to emerging markets for higher growth, but when you're buying into a place where the valuations are already reflecting that growth, it's really, really hard to make money.